Welcome back to Trading Hour here on CNBC TV18. The markets are tumbling back towards the lowest point of the day after that brief recovery that we had seen after that sharp fall. We had almost recovered to 22,100, but now we are back at that 22,050 mark, almost 30 points away now from the lowest point of the day. Let's get you some market opinion now. Pramod Gubbi of Marcellus Investment Managers is joining us on the show. Pramod, good morning. Thank you so much for joining in. We are heading into some uncertain times now with elections coming up, and there is no specific directional cue right now for the market, isn't it? And which is why we're seeing the markets doing what they are. But is there a general consensus now on the street that this current establishment will be voted back into power? And if that so happens, where do you see the markets going forward towards the end of the year?
Well, hi. Good to be back. Thanks for having me here. Now, look, predicting the markets in the short term is always, an exercise in futility. But, specific to your question in terms of whether that's the consensus view, it looks increasingly so, at least based on the discussions that we've had. Having said that, I'm no expert on elections, but at least the consensus view seems to be swinging that way. Now, in terms of implications on the market from that perspective, again, I think the market is a multi-factor place. That bit of news seems to be factored in. If much of the consensus view is that this government is coming back, likely that it's already in the price. To that extent, that itself, that event being a trigger for the markets looks increasingly unlikely. Of course, there are other potential events and triggers in the global markets which can give some direction. First of all, I think the geopolitical risks are on the horizon. It's only rising, which could have ramifications in terms of commodity prices and so on. The second is the much awaited sort of easing on monetary policy front, both globally as well as locally. I think at this stage, the weight is on, given that the economy seems to be doing all right. Of course, it's not roaring, again, both globally and locally. That's not driving a desperation on part of the central banks to start cutting. So, but I reckon sometime during the year, we should see the first signs of some monetary easing. That could be a trigger in terms of flows. Particularly, we've had a little bit of a lull in terms of foreign flows there, so that could trigger back. But I reckon, some sort of a correction would be healthy for the market. I know domestic flows are pretty strong, but my discussions with foreign allocators suggest that they like India, they like the Indian fundamentals, but they would prefer it to be a little cheaper than where it's trading at. So a bit of a correction could be healthy from sustaining the market for a longer run.
Right, but how much cheaper is too much cheaper, Pramod? Is there a multiple that you have arrived at where you feel that, okay, now the index or the market is cheap, let's put more money to work with?
Well, we are a bottom-up investor. For us, the market valuations matter less. I was talking more about the allocators. If you just simply go by the numbers, I think the current valuations for the market are significantly above historical means. But on an absolute basis, I think India has always traded at a premium to other emerging markets. That's less of a concern now. It's more about the valuation dispersion that we've seen. Particularly, I think within large caps, we are seeing pockets of value coming back. Small caps have clearly had a great run, and that's where valuation concerns are that much more. Secondly, in terms of factors between quality and value, we've seen a fairly strong rebound of value stocks in the market over the last couple of years. But as quality has taken a significant beating, both absolutely as well as relatively. To that extent, large cap and quality seems to remain in relatively fair zone as far as valuation is concerned. And that's where I guess there could be more interest coming through.
Okay. Pramod, just stay on. We want to get your take on the big PSU debate. And I know Marcellus, traditionally hasn't invested too much in PSUs. It's not these are not companies that I think you folks are too hot on. But I specifically want to focus on oil marketing companies. So allow us a minute because our colleague Sonal is standing by. By the way, a lot of the OMC stocks are under pressure today. HPCL is now down 3.5%. IOC is down about 3%. BPCL is also lower. And it has been a bit of a losing streak for them last couple of sessions after what has been a stupendous rally. That's what we're talking about. And if you pull up a one-year chart or maybe a 6-month chart of these stocks, it'll tell you the story, the kind of euphoric rise we've had, and just a bit of a cool-off that has set in, which also makes the space extremely hot in terms of the debate on the street. And it's a big debate between the bulls and the bears. And now, after a lot of the bullish voices, we're hearing a couple of bears as well. Nuvama is the latest one in the bear camp. Sonal, fill us in on all the details.
Well, yes, we've seen a stellar rally, as you pointed out. The stocks are under pressure. That's after a Nuvama downgrade that has come by. Let's do the bull versus bear scenario because the street is equally split, right? Let me start with the bulls first up and talk about Jefferies because they recently upgraded BPCL to a buy from an underperform. They raised the target price there. They say BPCL offers the largest margin of safety in the 3 oil marketing companies. However, they've also increased target price to IOC and HPCL. It's a big target price hike that we are seeing. Morgan Stanley remains very bullish. They say a well-supplied oil market, their hardware upgrades and refining golden age driven by the next leg of earnings upgrades will keep these companies in a good shape. HPCL and BPCL are their preferred picks. JP Morgan says that consensus EPS estimates for FY24 remain too low and that's why they've raised the target price across the board. Be it BPCL where it is raised to 720, HPCL where it is raised to 520 and IOC where it is raised to 205. Now let's talk about the bear scenario. CLSA downgraded these stocks in the month of January and since then the stocks saw one-way rally but they reiterated their sell recently. A cut in retail prices of diesel or petrol looks less likely now, they say, but a 5 to 7% increase in crude oil prices will pressurize their marketing margins and that would be a problem. And the latest one, Nuvama that is, the downgrade came by today. They say they are structurally disadvantaged and yet the stocks have rallied. That's why they have downgraded all the 3 names. They have an unchanged target price. However, they say refining capacities coming in will keep GRMs under pressure and that's why they are downgrading the stocks.
Okay, got that. Thanks very much for the latest on the bull and bear tussle between on oil marketing companies. Pramod, to come back to that question, what are your thoughts after having seen this stupendous PSU rally play out? Are you willing to consider any part of it at all, or do you think it's at its fag end? And within that, what's the sense on oil marketing companies?
Yeah, we've generally stayed away from PSUs historically because, like I said, we're more bottom-up investors. Key aspect of our investment philosophy is capital allocation and a high return on capital historically across cycles on a structural basis. That's where most of the PSUs sort of fall out of our screening and don't form a part of the universe. So honestly, we haven't really gotten much in depth from a bottom-up perspective in any of those cases. But having said that, if there is a structural change in the way capital allocation was made, governance was handled within PSUs, sooner or later that will reflect in the numbers and that will start appearing in our universe and we'll have no problem looking at them. But we'll need to see data that suggests that these changes are structural indeed. And therefore it fits into our philosophy and worthy for us to take a look at it.
All right, Pramod, we leave it at that. Thank you so much for joining in and sharing your views on the markets and on specific sectors as well. That was Pramod Gubbi there of Marcellus. Time for a short break here on Trading Hour. We'll get you more on the markets on the other side. Stay tuned. We'll be right back.